serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant. And, of course, with me, my special guest on the Quest, Ken Davis from Bell & Associates. He's the Vice President of Advanced Sales and guru to the stars on the fiduciary community of the CPAs. And on top of that, if you want to go ahead and contact Ken, you can. You can write us or call us at 1-800-290-7226. We'll forward it on to him because he's our good friend, and he'll help us out, and he's going to help us out in this next segment. Ken, before we get into the whole thing about Social Security, we're going to talk a little thing about how to fix this.
Sure.
Not just complain about it. Let's fix it. The first thing, though, we want to make people aware, because there's a lot of people out there right now converting their regular, traditional IRA into a Roth IRA, and that may be a good thing.
It really depends, but yes,
depends.
it could, or maybe it's not.
But maybe if I'm taking my Social Security in the same year that I make that conversion, that could be a problem.
Well, sure. You might be in a tax bracket or a certain level that you either wouldn't be taxable on your Social Security income or maybe partially, but that extra income chunk that comes in 1 year may push you into higher tax brackets as well as higher percentages of your Social Security income being taxed.
So be careful. If you're taking constructive receipt of your Social Security, just be advised that a conversion could be an issue. Now, of course, once you're into Roth, there's no issues here, but the conversion is the problem.
Well, that's correct. And in fact, you have to weigh the impact of that one tax year and the additional taxes you have to pay, and that's a big issue. But if you can get through that 1 year, you may have future years where you now have permanently reduced the income that you're taking from qualified plans or IRAs and may permanently reduce your adjusted gross income that impacts so many other deductions, credits, and exemptions.
Right. You know, when we're thinking about some of the ways, I never thought I'd ever come to this in part of our practice, where we would be talking about investments that actually will protect your Social Security benefits from being taxed.
Sure.
I never had to really address this before,
Sure.
but I guess we should. Talk a little about some of the solutions, because we have a lot of seniors listening to the show. We have a lot of advisors. Remember, our national network is over 250,000 advisors we distribute this show to, and these would be great for them to be able to offer to their clients as well.
Sure. There's financial products out there, and your advisors would know about it, and some of your CPAs will know that you can defer your income taxes. You can actually accumulate growth and income inside these financial products, very similar to what you do with an IRA. You can defer it, and the importance of that is if you don't need that income today and it's building on a pre-tax basis, that means there's less income coming through that's taxable, and that can reduce your adjusted gross income and increase now, as you reduce AGI, you increase the potential of deductions, credits, and exemptions.
I think our listeners would like to give me an idea, give me an example of maybe some kind of tax advantage product that I can still have some guarantees, still have some income, sleep at night, and I can either at least delay Social Security getting taxed. Is there any little helpful hint we can kind of give some of our listeners?
Sure. I mean, there's a particular product out there called an immediate annuity that allows us to take my purchase price. Remember, we talked about tax basis early in the week, where I can, as I take the distributions out, a big part of that's considered a return of my own money, and so it's not taxable.
Not taxable, right.
So I could set up an immediate annuity that would create an income, say for 5 years, and about 90% of the distribution is tax-free, which reduces my gross income, which reduces adjusted gross income, and makes my deductions, credits, and exemptions more effective. And then in the meantime, I can put it in what they call a deferred annuity, where I'm growing it much like I would with an IRA or qualified plan. And you can do this with life insurance as well. People don't realize you can use insurance products to accumulate wealth on a tax benefited basis. Now, of course, life insurance is life insurance. There are costs associated with that. For that.
That's a value proposition.
Yeah, it may or may not make sense for you, and that comes down to who your advisor is and how qualified they are, and if they're, looking out for your best interest. These can be used very legitimately.
I just want to be able to point out that a CPA just said that about life insurance, and Ken teaches at the CPA Society. He's been former president of the society here.
Well, the local chapter years ago.
Years ago, and so when he comes and says this, I think it's more powerful than I would say it or some of our other guests that we've had on before. It shows that there's ways to play here. And of course, it has to be done correctly, because you can be hurt with some of these products if it's not done done right.
Yeah, and let me make a really simple point. Annuities, insurance policies, IRAs, qualified plans are tools.
Mm-hmm.
Okay? I can use a hammer as a tool. It's neither evil or wonderful.
Mm-hmm.
It's just a tool. Mm-hmm. If I take that and smash a window, obviously that's a bad thing to do, right?
Mm-hmm.
That's destructive. If I use that same hammer to build a house, that's a positive thing. So it's not the hammer that's good or bad, it's the person that utilizes it. And even if you don't have any evil intent, if you don't know how to use the hammer properly, you may hit your thumb with it and curse and hurt damage your body. So it's not only, it is a tool. Tools can be used correctly or incorrectly with good intent or bad intent, or it doesn't matter. They just use it inappropriately.
Well, I was thinking about what you said about immediate annuities. I mean, the rates are terrible right now.
Sure they are.
However, if I was taking income off part of my, let's say my investment, I had $100,000 and I was going to take 5 years of income, maybe it was 25, 30 grand. And I was receiving that money, most of it would be return of my money anyways. There'd be a little bit of interest on there I'd be able to get, but probably not any worse than what I'm getting at some of the banks and money markets.
That's correct.
But by deferring it, my other portions of my money, I'm letting it accumulate tax deferred. So in kind of a sense, for about 5 years, I would be able to have money and also grow money again without paying any taxes. Now, sooner or later, I'm going to have to pay the piper here. I can't just delay it forever.
Sure.
But I can mitigate some of this, can I not?
Well, and let's talk about that. You're absolutely right. Number one, single premium immediate annuities have very low rates right now and may not be the best solution for that formula. But remember that your other assets like certificates of deposit and money market funds and stuff like that, I mean, a lot of them are less than half of 1%. But it's how you layer the products, the deferred accounts, deferred annuities, IRAs, whatever you're using. It's sort of like, wouldn't you like it if I came to you and said, Steve, wouldn't you like to make an interest-free loan from the bank, and the only requirement that you do with that money is you go invest it somewhere. And as long as you keep it in those investments, you pay no interest on that loan. So you get a 0% loan cost. You go out and make 3% somewhere else. You're making that 3%, and the bank's giving you 0%. Wouldn't you sign up for a loan like that all day long? Well, that's really what deferral is. When you defer taxes you would have paid today, the government, in essence, is giving you an interest-free loan.
Now, we're not escaping taxes on deferral.
No, you're deferring it.
You're just delaying it.
Right, and what they're saying is as long as you keep it in those types of accounts, we won't tax you on it. So all those earnings build tax deferred, and then ultimately when you decide to take it out, sure, there's going to be taxation at that point, but you've been using that money and investing it and growing it for yourself. And the government, Congress did this on purpose. They want to incent people to put money away from themselves and utilize things like IRAs and annuities and life insurance products to accumulate wealth on a tax benefit basis because there's a social good. Your retirement social good, taking care of your family with life insurance is a social good. That's why they allow those kinds of benefits.
And if doing this in a tactical way, in a strategic way, you can help mitigate some issues like Social Security. If you delay, you could take your Social Security and not have any worries because you're deferring these other products.
Sure.
So,
and let me make a recommendation. These things aren't, you can't make these decisions in a vacuum, and I would highly recommend that you either use your financial advisor or your CPA or accountant and say, look, I want to look at some different alternatives and I want to see what the impact is. Have your accountant or your tax advisor, maybe have your own software package, run it through and say, if I made this change, what's the impact? And I'll give you a quick clue. Line 20B of the tax return, if our retired folks out there listening go to 20B on their 1040, they'll see the amount of their Social Security that's being taxed. Now, if you see a sizable number there, there's a possibility of some decent planning, and that'd be a good thing to go to your advisor and say, I want to do a tax projection. and using some tax-deferred strategies, combinations of
Let's make
different
sure
things.
we understand that, because remember, we have 250,000 advisors getting this show as well.
Sure.
And this is a great idea for advisors to suggest to their clients, because we want everybody in America to know what's going on here
Sure.
and to take advantage of this. So on my second page of my 1040, line 20,
No, first page,
page.
line 20B.
line 20B. And what I'm looking for there, that's what I'm getting taxed on Social Security, right?
Yep.
And that's, if I'm having a pretty big chunk, there are some maneuvers to be made.
Right.
Now for 2010, it's probably too late.
Oh, yeah, it's
Okay.
too late for 2010.
All right, but this is the time. He says, well, Steve, you're talking about this in February. Well, we're trying to get you to start thinking about this. We're going to come back in April on this issue. We're going to come back at the end of the year. We want to be able to give you opportunities to start thinking along these lines to reduce your tax bill before the end of the year.
Yeah, and think about it this way. I mean, you can do year-end planning for deductions, and one of the few deductions left are contributions to IRAs, qualified plans, and stuff like that. But in order to get tax deferral, you get to defer the gains on growth and income. You got to start at the beginning of the year. You know, when you put your money into instruments that grow or earn interest, they have to grow it during that time period. So if you wait till December 15th to do it, it doesn't do anything for you. It will for the next year, but not for the current year. Deductions can matter at the end, but not not deferral.
Well, when we think about using deferrals, and there's a variety of different kinds of annuities as well. Maybe the long haul thinking, you may even want to start considering indexing, because it does kind of, in a way, it guarantees principal on almost all those contracts that you and I have reviewed, right?
Right.
So,
Yeah, and we're now getting into some more sophisticated products. You want to deal with, you know, a qualified advisor,
sure.
and get your input from your accountants and with your financial advisor, and make sure you understand how to use these. But yes, using the tax deferral mode is a good way to do it. Getting guaranteed returns. Yes, they're small, but you can get 2.5–3% on fixed annuities. Index annuities have some further upside. They're kind of complex transactions, so we're not going to get into detail on that, but it's a possibility of having higher returns and reasonably safely. And people, I think, are looking for safety. They're looking for tax benefits. And some of the tax benefit products like annuities and life insurance and IRAs and all that stuff can provide those kinds of things.
Oh, I like the aspect of paying taxes when I'm actually going to use the money.
Yeah,
You
that
know,
is appealing.
That's the biggest appeal of these tax-deferred products. I pay it when I use it. Well, Ken, I want to thank you for being on our show today. I want to thank our sponsor, Brokers Alliance, and America, where anyone can go on a quest for financial freedom.